Hey, it's Mike again. Wow, this is one I've been wanting to do really since probably the third one that I did when I did the Cisco model book um, one, and I was deciding between Cisco and this one, and went with Cisco because that one I like better. But this is my favorite Bill story that goes along with the chart, and so it is Amgen. We're going to walk through um, the Amgen 1990-91 timeframe move using my Quicksand and Grateful Dead holding rules and walk you through how they would have worked during that. But I'm also going to touch on how Bill traded it and really my favorite Bill story that he used to tell me the story all the time, and I kept on acting like I'd never heard it before because every time he'd tell it, he would tell it slightly differently, and he would remember a few different things. And I just kept acting like, oh, it's the first time I've ever heard it. And once you hear some of the details, you'll know why. But we'll get into that in a little bit. But let me share with you how he marked it up at one point. And let's see. Yeah, you can see that, right? Let's see. I gotta maybe blow this up a little bit. Okay. No, that's a little too much. So this was a thing that he had in the paper for a while, where he went through and looked at some of the model book stocks and marked them up how he would have wanted to trade them. And Justin did most of the heavy lifting on this with him. I was not involved with these at all, but it was basically Bill and Justin who did these, and it's a great thing. A lot of people have printed them out, and I've seen people frame them and put them on the walls in their house and stuff. And I would do that too. This is cool stuff, man. But just the reality is, he would mark up these charts differently each time he did it, and so you should study these. We might do something again in the newspaper with them, or a variation on this theme. But the concept was these big model stocks, and again with this series, I have one of the episodes that talks about how to build a model book, and I'll share that in a second. But what he really would do is, and what the foundation of everything at IBD and everything that he did, was to look at stocks at the beginning of their move, and then that had huge moves, and just study them. What did they look like at the beginning of the move? What did they look like at the top? Now I'm focused more on the what happens in between. But if you don't have the beginning and the end, you can't do the in between. So you got to learn, all three of those things. The easiest part is where to buy. The hardest part is where to sell, and the trickiest part is really everything in between. So, man, it's this is a challenge, but this is why we study it. But as he would go through, he would, just mark it up. Again, this isn't how he traded it when he would mark these up. It was how he would have wished that he would have traded it. Now, sometimes he traded better than how we marked them up, but most of the times he didn't trade them as well as he marked them up. But it was a procedure that it was really the core of everything that we did at the firm, and really what he did even before I was born is just studying the models, and then seeing what changed over time. And most of the things didn't change because fear, greed, and hope is what makes a stock move up and down, and that doesn't change, even though we have algos and everything in place now that alter things in the very short term. In the intermediate and long term, I mean, that is still people doing that, and there's people behind the programming of the algos. So it's not like these are just 100% AI driven algos that go in and buy and sell. It's someone designs it, and so there's that fear, greed, and hope that we all learn from from Jesse Livermore. And let me just go to my YouTube page because I just want to, while I was thinking about that, just kind of share. Let's just share this. Because for some of you, this might be the first one that you've joined us. Well, I guess it's not us, it's a me. It's weird. Bill would have a thing where you weren't allowed to say I or me or you. You know, it was always we, us, and I love that. And that's something I think he picked up from Reagan because he would count how many times in a speech, like Reagan would say us or we or what have you. And then he would do the same thing for other politicians. And he would have me do it and listen to an entire speech and count how many times someone would say, I did this, I did this, I did this. Well, sometimes you have to say I because it is I, but as a general thing, you should say we or us or what have you. And anyways, it's just a little tidbit. And of course, I'm rambling already. I told myself I wouldn't because I'm not doing this on the weekend, which I normally do because I'm going to be tied up on the weekend that I'm going to release this one. And so I'm like doing this after a long day. This is a really hard day in the market. Well, not a hard day. I mean, not for me, but it was a tricky day in the market. And so I'm just kind of wiped out. But anyways, here's all of the ones that we already have in here. And the first one was done on precedent analysis. That is something very important to do. And it was focused on what happened on December 18th with the Fed announcement and the shift and the bad break we had and trying to find precedents for that. That's still really valuable. And I would suggest that people go through it because you'll learn a lot, a ton from it. But the one that, if you're into models, which you should be, number 2 is how to build a model book. And then Cisco was the one that I was talking about. That was number 3. That was a model book study where you were did the same thing that we're going to do on this Amgen one. Then same thing with, let me bring this over here. Same thing with Apple here. That was a really good one. Google as well, and with the Google, I also introduced how I did I created the IPO base using Google. And then, there's why I created the composite rating, how to use it. Same thing on why I created the growth 250 and how to use it. How I like to use market search because everyone uses it slightly differently, but that's how I like to use it, and that's that thing. But then probably the ones that you should do first, because this is, if you're watching this anytime, while this market is still tricky and we're underneath the 200-day and everything, and assuming that by the time I've released this one that the market hasn't turned and ripped up, who knows? But I would study the follow through day, which is number 10, and number 9, which is the 21 day, because they really go together. You can do them in either order. Then after that, I would do the number 13, which are follow through days underneath the 200 days. So I would really do number 9 and 10 first. Before you do 13. And I would do all 3 of those kind of together so they're fresh in your mind. So probably 9, 10, 13 would be the most important thing for the market and making sure that you get the turns down in the market right. And then, of course, I also did I forgot to mention it, the 3-month RS rating. But really my favorite one, the one that no one wants to watch, is the one on fear, number 11. And I've got to say, that one has nothing to do with trading at all. It's just about fear and how I've dealt with fear in my way. I would like to say it's unique, but it's probably not that unique. It's just how I did it, and the pros and cons and all of that. And I've got to say, I was so happy that my older sister, Just a wonderful person who really great heart. That she's I don't think she's traded a stock in her life, and nor does she have any desire to. She's a school teacher, wonderful elementary school teacher, and has been, since she graduated from college back in the day. Uh, and she watched it for some reason. I don't know why she watched it or how she even knew about it. I didn't even tell her about these, and she sent me this wonderful text and twice, like that she watched it and how good it was, and it was just really made me so happy. My father did the same thing the other day too. That was really really nice of him. And I'm sure my mom was going to watch it too, but she was tied up with something that day. So, but I think she's watched some other ones, and yeah, just wonderful family. So, anyways, yeah, but definitely watch the fear one, or just listen to it when you have when you're driving somewhere. Just don't fall asleep. So, anyways, today we're going to do. So again, if you're new to this, start with a 21-day and both follow through days. Those are the most important ones. And I know they're long, they seem long, but I would do when I'm talking during these at the beginning before I get into charts. I would listen at 1.5 times speed or 2 times speed. It'll make it easier to deal with my voice. I know I have a vocal cord issue, and sometimes it's hard to understand me at a slow speed. It's easier on a higher speed. But then once you get to the charts, you probably want to go back down to 1x or maybe 1.25 x to just get through that. And that's what I do when I listen to podcasts or books on tape. I'm always changing the speed depending on what the content is. But a lot of these are backstories. And then when I'm done with the backstory, I kind of go like this. If you're fast forwarding through, because I just don't know how to put the little clip things at the bottom because I'm just doing this on my own. And I've said this on all of these, but because I never know if it's your first time or not, but that I started this for two main reasons. One, I wanted something to help all of you because I had zero help starting out, and I every roadblock imaginable under the sun put in front of me that I had to go through with zero help and a lot of people trying to not let me succeed. But it is what it is. You push through it or you do your best. And so I was like, when you get through to the other side of the learning curve, and I still have a lot to learn. I mean, when Bill retired, he was still learning. Every year, I was noticing him doing things differently and learning and talking about things that he noticed, and we would work on research things together and discover things. So even him, that late in his career was still learning, so we all have so much to learn. But anyways, I wanted to be able to share whatever I've learned to help you with your learning curve and to just speed up the process because it sucks, man. Like learning the hard way sucks. And so if you can gravitate towards some folks who are pointing you in the right direction, do it. And I'm not an investment advisor. I don't play one on TV. I'm just a random dude who likes to help out folks. So get your own financial advisor and all that stuff. This is not investment advice. This is just me trying to help you out. And if you have trouble sleeping at night, you can put one of these on and it'll do the trick. I actually do that. I do, man. When I can't sleep, I just put one of these on and I go, oh God, why did I say that? Should have said it this way. Now, the other reason, the main reason why I got this idea was, life has a way of letting you know what's up at times and how life isn't always super long. And I wanted to have something around for my kids if they ever got into trading, because right now they're 23, they're twins, and they're starting their career and they're just really not into trading, and I don't want to push them into trading. If they ever just come this way on their own, well, man, I'm happy to help, but it's not something I want to push them into. I've always wanted them to find their own way, and just help them out as much as I can along the way. But they're perfect kids, frankly. Couldn't be more different and couldn't be more the same at the same time. Any parents out there of twins, you kind of know that. So I just wanted to have something, and I was thinking, if I'm not around when they have kids someday, I wanted something to pass on to the grandkids. So this is what it's kind of. I'd been watching How I Met Your Mother, that series where the mother had passed and the father is telling the story to the kids of how he met their mother, and just I'm just like, wow, what a great concept, and want to do that. And then I was just gonna record all these and stick them on my computer and just say, hey, like here they are for the future. But I figured that, man, they'll probably just get lost, or they wouldn't know the password or whatever. So I figured throw these on YouTube and take care of two things at once: help folks and have something archived there for my family, and also to let them know what Daddy's done, because I don't really talk about work with the family. I just it's just not what I like to do. And so anyways, that's what this is for. So you guys are all benefiting from for that, or hopefully benefiting. These are free. I could charge a ton for these. And I just, want to have, I'm a believer in karma, and you get what you give. And sometimes it takes a while for that to come back around, but yeah, we'll see. But anyways, let's get going with this stuff. So we're going to go through Amgen. Um, Monster move back in the early 90s time frame, and Bill capitalized on it in a very big way. But we're not going to focus so much on his trade. And again, I'll so you don't have to rewind. I'll just show this again. So this is again how he marked it up along with Justin, of how to study it. And we're going to start it at the um, at the beginning down here and then go all the way up. But we're going to do it more using my technique for holding. And I've discussed this technique in a few other episodes, and it's called the Quicksand and Grateful Dead rules, and they're to hold. And I'll get into the specifics in a minute. But the concept came about as I do a really good job at buying a stock initially. That's what I've focused on and kind of gotten down. But and I can recognize the topping stuff for the most part. I mean, you know, as well as anyone can really do, because you never know. But it's the in between that would mess me up all the time, and it still messes me up. And so I needed a rule around that to get me to hold the stock, because what tend to happen is I would get all excited about it and buy a bunch of it, typically buy too much of it. And then when it's doing normal kind of sideways action or coming down, I would get worn out or bored with it, and find something else to put money into. And then before you know it, it would resolve itself and move back up, and I would be out of the stock. And I'd be like, oh my God, I did all this work. I found it exactly right. I would know exactly where it should probably be sold for the most part at the top. But in between, I'm just not holding it right. So how can I resolve that? And so Bill had really only one rule specific to holding, and that was his 8-week rule, where if a stock goes up more than 20% in 3 weeks, he'll hold it for 8 weeks. And whenever I would implement that, um, for one, that it worked out. They don't all work out, of course. It was like, wow, it was really relaxing, because I remember, what was that? I think it was either GenProbe or Crocs, and I had it, and there was a downgrade on it, and I had a big position in the stock. Might have happened in both of those, and it was the thing was a downgrade, and it was down a whole bunch, like 9% or something. I don't know. I'm just from memory, and 9% is a lot on a big position on anything, but on a core position. But I remember not panicking and just going, oh, well, I'm in this 8-week time frame, can't do anything with it. And so when you're on autopilot, it reduces the stress, because you're like, yes, this could come down another 9% and another 9%, into a point where it does hit this one threshold. Because the one rule was, yes, you buy it and hold it for 8 weeks if it goes up 20%, but you're not allowed to let it turn into a loss. So even though he didn't explicitly say that, if you back into it, if you read his book and read between the lines and kind of like, um, like read this paragraph and this paragraph and you put them together and you're like, oh, well, you never let a big winner turn into a loser, but hold it. And so anyways, the rule is don't let it go. Don't let a big winner, meaning something over 20% is a big winner, turn into a loser. So you got to sell it before it goes down your 7 or 8% from your purchase price. So the rule with the Quicksand Grateful Dead was for holding a winner. That's a huge difference. You do not use these rules, whether you're using them on a daily, weekly, or monthly, to hold a losing stock. No go, no bueno, don't do it. This is, again, my way of trying to hold it for a big move. And yes, I will show you some charts and walk you through. So, again, I was trying to find something that I could lean on myself to hold my core position. Now, it wouldn't be to hold all of the position, but to hold part of it. So as we go through this, one of the things you want to know is with these holding rules, it is designed around holding a core. And a core does not mean your entire position. So before we go into this, you want to think in your mind, what is your max size position? And if you don't know that, make a note of that right now. Like I always have a, notepad with me, and like to take down notes throughout the day, anything that's important. And Bill did that. He always had a yellow notepad with him, and he would walk around everywhere with that yellow notepad. And I still have a bunch of those old ones. When he was done with them, I would just, take them, just, he was fine with it. He's like, oh, here's one, Mike. But with all of his notes in it. And so write a note to yourself that you need to find out what your maximum position size is for this, for this model book series, the Webby Rambles On podcast. We are just pretending like our max position size is 25%. For you, it might be higher, it might be lower. But for this, is just to make the math easy. We're saying your maximum amount that you're going to have in any one stock is 25%. And of course, you wouldn't build it up to 25% if it's a losing position, right? You don't want to have 25% of your account into something you're down on. So this is something you would pyramid into, and your max position would be 25%. But your core, we are going to say, is 15%. And this is of your account. So let's say you have a $100,000 account. So 25% of that would be $25,000. And of course, if you went on to margin, you could put 200,000 in the market, but we're talking as a percent of your equity or your account value. So 25,000, and then your core is going to be 15% or 15,000 in this example. So you're from 15 to 25%, you could sell in other ways that we're not talking about during this. And that would be like offensive selling, or just for any other reason, the general market, the rest of your account, whatever. But then your core position of your 15%, you're going to try to hold until these rules trigger. The Quicksand Grateful Dead. And, I did name them that because, frankly, like I've been saying in these, I've developed so much intellectual property over the decades that I've forgotten a lot of it. And it just went under the blanket, William O'Neill or IBD, and I don't own it. And people own my stuff, I feel like an old, blues guy or something who, like a Muddy Waters or a Buddy Guy or stuff that early on, a lot of people making money off of them, and same kind of gig, tens of millions of dollars were made off of my stuff, and some would say even more, and without a dime flowing to me. So another reason why I'm just giving this away, man. Like, if other people are going to make all this money off of me, I'd rather just help you guys. So so the reason I came up with these goofy names like my Webby RSI or Quicksand Grateful Dead is like, I wanted, if people were using them, to at least like, who's going to say a Grateful Dead rule without it being known that it was Webby's rule? So that's why I'm putting these goofy names, and everything that I develop is going to have a goofy name on it, because I want something for my grandkids. I'm not making money off of it any which way. So like, at least something for my grandkids to go, hey, my grandfather invented the Quicksand and Grateful Dead, and people are still using that. And I don't know why my grandkids would talk like this, but maybe they moved to, I don't know, Arkansas or something. So let's get into this stuff and walk through. God, this is going to be fun. Let's see, share this puppy. Make sure that I'm sharing the screen right, or this will be a disaster. Yeah, it looks like it's right. Okay, so this is the Amgen on a weekly. This is out in at the top of the move. So we're going to be studying it from here to here. So I just want to let you know ahead of time, because as you're doing this, you really need to get in the mindset that you don't know that this happened. So every bar, you want to pretend as if the stock completely collapsed. And it's critical that you do that you use intellectual honesty, as you're going through it, and you pretend like you don't know what's happened. Otherwise, this is worthless. If you can't do that, turn this off until you can. Don't watch it. It's going to hurt you more than it's going to help you, because it's really, really important that you're honest with yourself. I've seen so many people who, look at these things and they know that, okay, the stock topped around here. So then they look for those sell signals that, if they knew that the stock kept going up, they're going to ignore. And that nothing drives me more crazy than that, because I've seen almost everyone does it that way. It's just true, man. I've noticed a lot of people do it that way. And, you don't learn that way, because then when you're in the battlefield and the bullets are flying at you, man, you're going to be like, well, I don't know. Tell me what happens next week. Well, you know what? They're not going to tell you what happens next week. Your job is to figure that out in real time, and you're going to be wrong all the time in the market. Deal with it, man. If you're a perfectionist when it comes to the market, you're in the wrong gig, because it's just not going to work that way. And so you're going to make lots of mistakes. Bill made lots of mistakes. If Bill made lots of mistakes, then we're all going to make lots of mistakes, right? So we're going to study this from this move. I'm going to walk you through where and how he traded it to a certain extent, but we're really going to focus on this Quicksand Grateful Dead, and we're going to focus on it on a weekly basis. You can use this on a daily basis, weekly basis, and a monthly basis, and there's different times for each one. So you would use it on a daily basis when you're just starting and getting your initial cushion. And then once you've got a decent cushion, and decent is really subjective, and I don't have an exact amount for you. It'd probably be in terms of ATRs, like how many ATRs you're up on it. But let's just say, like, as a blanket thing, like once you're up 15 to 20% or something on it, then switch over to using the weekly Quicksand Grateful Dead rules. If you are fortunate enough to get up 100%, or so on a stock, maybe 75%, you could switch over to monthly if you want. And that's if you really want to just try to hold something for, a really long time, and you don't like trading a lot, or you really have a lot of conviction in it and you want to let it base build, then you'd use monthlies. But we are going to focus on the weeklies for this exercise. In the future, I'll do some on monthlies, and I'll do some on dailies, and dailies are more for getting started and then swing trading. So what is Quicksand Grateful Dead? I've discussed this in previous ones, but I'll just review it. So it's about these RS lines. So the RS line is just a measure of how the stock is doing versus the S&P 500. So with, oh, and I should have done this. I guess it's obvious because the chart's up, but yeah, we're getting going. That the RS line is how is this doing versus the S&P. So if the line is moving up, or let's say it's just one bar that you're looking at, and the S&P is up 1% for that time frame, and your stock is up 1%. So that RS line is going to be flat because it's just in line with the S&P. But if the S&P is up 1% and your stock was up 2%, it's going to be up a little bit. And if, let's say, the market's up 1% and your stock is flat, that RS line is going to have a dip. And so any bigger moves, up or down versus the S&P, it's just a ratio. It's like, how much is it up? And so any one day or week or month doesn't really make a difference. It's the trend of it. And so that's why I came up with, and it was my idea 20-ish years ago, to put moving averages on this RS line. And that's what we've got here. And I'll show you how to do it in Market Surge. You go up to this little wrench thing, you go into your RS line here, and your default RS line, or I call it my RS line 1, and you want to have this index to the S&P 500. Now you can also change this to other ones, or you can change it to a symbol. So if you wanted to compare two stocks versus each other, or an ETF or anything else, or the group, you can do that as well and then compare it against its group. But for the daily, I like using the 21 day. A weekly, it's an 8 week. A monthly, it's a 10 week. So 21 for the daily, 8 for the week, 10 for the month. For the RS2, I'll also put this to the index, to the S&P 500. And then for the daily, it's a 50, a 21, and 24. All of these are simple, so don't click on exponential. In the future, we might, once I do more testing, we might switch some of them to the exponential, but for now, we're keeping everything as simple. So again, 21, 8, and 10, and 50 and 21. So the 8 is this orange one here. Your RS line is the green one. Yeah, let me blow this up a little bit. So your green one is your RS line. Your orange one is your 8 week, and your blue one is your 21 week. And the concept is that you are trying to buy a I'll just stop share for a second. So you're trying to buy a leading stock, right? And by definition, how is it leading? It's leading if it's outperforming your bogey. Your bogey in this case, or your benchmark, is the S&P 500. So I like to kind of boil things down to the simplest level. So you could say, oh, I want the stock with the best earnings growth, or I want the sales growth, or the best return on equity, or the best story, or the best fill in the blank, any other metric, and they're the best market share, or market share growth, or total addressable market, or what have you. But really, what you really care about is the stock you're buying beating the S&P or not. And if it's not, then just buy SPY, because with SPY, then you get the added benefit of 500 stocks diversified versus your one individual stock that anything can happen to. So if it can't beat SPY, then why are you trading it? Now, it doesn't have to beat SPY every day or every week or even every month, but it should have a trend of it, right? It should trend above it. And that's why it came up with this. It's like, okay, we are trend followers and we're trying to buy leading stocks. So what's simpler? Again, it's always that Einstein quote of, make things as simple as possible, but not any simpler. So, okay, I'm trying to buy something right, and I know what a pivot is. Okay, so I've got that. And I'm trying to hold a winner. Okay, so I'm only going to apply these rules to winning stocks. And then I'm trying to hold something that's still winning, but I know that it's not going to be winning every day or every week, and it's got to go through some corrective, normal, natural phases. but how do I know what is normal and natural on a relative to the S&P? And I was like, okay, well, if you use a moving average of your relative strength line, that's going to capture it, right? It's like the gold, like it's the most obvious thing. And I don't know why no one ever figured that out, or if they did, I just never read about it, or, or they didn't do it quite this way. But that's what you're after. You're trying to trend follow, right? Because object in motion stays in motion. So once you get the stock out of the pivot and you've got a little cushion, you're trying to let it wiggle and wobble. Something I suck at, right? That's my worst thing ever, And so why I developed it, and that's what you do. You want to develop rules, for your weaknesses. Turn your weakness into a strength. And that's something for everything in life, right? Whatever you're the worst at, try to figure out a way to make that something you're the best at. And so I'm the worst at holding. And so that's why I developed these to try to, become as good as I possibly could be at holding. And I still have work that I could do on this to improve it. But this is, something I'm really proud of, and most people would not share this. I guarantee you, if Jim Simons had figured this out, and I'm sure he figured out a lot better things than this, and even that the worst thing he didn't even share. So I'm sharing it with you to try to help you out. Nothing I'm getting paid for ever on this, and just wanted to help folks out. So let's go back to it and just kind of go over the basics. Oops. Shoot. Share screen. Just terrible at this stuff. Okay. Hopefully this is working. I need a video crew. All right. So the RS line is in green. This is your quick line. This is your Grateful Dead line. So how the rule goes, and let's just pull up a different stock on here. I'm just going to pull up Microsoft during this time frame. So when you're here and the RS line is above it, you're holding your core position. Remember, we said our max position is 25% of our account. Our core position is 15%. And just to keep the math easy, we're going to say we're going to hold this core in 3 chunks of 5%. So 5, 10, 15%. So when the RS line comes through, and let's just do it over here, 7.6. I should have just put the date in. Okay. On this week, it doesn't look like it. Let's just say that it looks like it hit it. So when that hits it the first time, that's considered the quick. So the RS line hits your 8-week moving average of it, and you're saying, okay, I need to trim some of this. So I had 15% core position. Now I'm going to bring that core position down to 10% because I'm selling one of those with my quick rule. Now the quicksand is if that keeps going lower. So let's go out a week. Okay, it moves back higher. So now we have this line in the sand at this level there. Now, since it's moved back up, if you wanted to, you could buy those shares back. That's totally within reason. And a lot of times that's what you want to do. Now we go out another week. Now it's come back down, and you can see not only did it undercut your RS line moving average, you also went slightly lower than you were before. So that becomes kind of a gray area where it's quicksand, because you had moved up for a point or for a little bit where you were breaking out of this flat base. So you could have said, okay, you moved it back up to a 15%. So we're going to just say that for this example. So here you sold it down to a 10% position. It breaks out. You would definitely buy that back, breaking out of a flat base. So now it's a 15% position. Now you've got another quick rule. So now you bring it back down to 10. And there's some judgment in there, but we'll just keep it as black and white as possible for now. So now it's gone lower than that. So here was your quick signal because the RS line went through that moving average. Now it's your quicksand, and I call it quicksand because it could slowly just evaporate all of your gains in there. Um, and so now you sell another 5%. So now you're just down to 5%, and you're waiting for it to trigger this Grateful Dead signal, which is here. Let's go out another week. Okay, there you go. So now this is your Grateful Dead signal because it crosses that blue thing. So this would be, if you bought it over here, maybe you bought it over here. So you've got gains on it, and then you're selling your last little bit there. And let's just go out a couple months. And see, so that's where you sold it. And look, would you have really wanted to sit through that? And you can always buy the stock back, but you don't buy it back unless that RS line is moved back above both of those moving averages. So that keeps you from getting chopped up like in this time frame here. If any of those days look really compelling to get in, you just wait. Now there are exceptions, but as a general blanket statement, that's what you're going for. So now that you understand, Quicksand, Grateful Dead. Quick is going through the line. Quicksand, it goes lower from there. Grateful Dead, where you sell all of it, is when you go through the blue line. Does that make sense? I hope so. So now let's move back over to Amgen. And again, we know that it topped out, out there, but we are going to study this from down here. And I will say that Bill didn't start buying it until over here, but we're going to start it out down in this double bottom and walk you through how it would have worked. And I'm sharing and I'm trusting you that you're going to be intellectually honest as we go through this example, because what you're trying to do is learn. You're not trying to prove how smart you are. You're trying to learn. And I haven't done this one in years. So I'm going to be learning as you learn. And that's why we do this. I mean, we would do this all the time. I mean, that's what, not the Quicksand Grateful Dead, but, we would do this. Stop sharing. We would do this all the time. And that's what Bill would do. He would have his model books that we would build. They would have a chart on the left side of what it looked like at the beginning of the move, and then a chart on the right side of what it looked like when it's topped. And he would just mark them up. And I had all of his, for a decade plus, I had all of his personal model books, because whenever he would bring one in my office, I would just keep it, man. And I would just study it. And he knew that I had them, and I had just stacks and stacks of them. And in fact, I was going through some boxes, and this is, shoot, my thing just froze. Not sure if you can hear me. I'm going to pause this. Well, that was strange. I'm not sure how much that froze or what have you, but all of a sudden it said it stopped recording. And I'm like, oh no, man, hopefully all that other stuff worked, because I don't want to say all that stuff again. But I was just reaching over to grab this magnifying glass. And this is kind of a funny story, because this was the one I had way back when, and I would use it all the time to, then I bought a bunch of other bigger ones, but this was like sentimental value, because when Bill and I first started working on projects, it was kind of because of this. So what would happen is he would always be trying to improve on the newspaper, because the newspaper was his baby. And I know probably anyone new, younger, probably maybe never even really used a newspaper. You saw your parents or your grandparents use it, but you never really used it. But like, he was a newspaper man, like that was a big deal, and it was a big deal for him. Like a newspaper thing was a big deal, kind of thing of, like social media back in the day, like decades ago. or even way back when, like you think of like the Hearst family and stuff like that, like, newspapers, big deal. And so he was always tinkering with his newspaper because he was always trying to catch up to the Wall Street Journal, which is interesting. And so he was always tweaking the tables and trying to put in extra information. He hated white space. If there was like any space that wasn't being used in the newspaper, it killed him, because each piece of paper costs money. Like if you were like, putting these on newspaper or on printing them, at different plants around the country, and then putting them on trucks and in planes, to get up to Alaska or Hawaii or, Europe or whatever, it costs a lot of money. And so each page was, cost a lot. So he would try to squeeze in as much as he could in a shorter period. So he was always redesigning things. And when you would normally do that with IBD folks, right? And I was a William O'Neill person, but I just happened to be sharing his office with him when he was down in IBD. So I would do a lot of IBD type of stuff with him, which is where I work now. But the rest of the companies were really separated, because one was institutional and this one was, IBD Market Surge. It used to be Daily Graphs, and that was Market Smith. That was retail, and William O'Neill was institutions like hedge funds, mutual funds. Fidelity was our biggest client, and those types of things. And so where this comes from is, so he brings in these big reams, these big giant reams of printouts of different. It was like A, B, and C version of different fonts and different ways of changing the stock tables. Because he would go through the stock tables every single day in the paper, and that's how he would do his screening. And he would circle it with a pen, or highlight, or typically a pen, and circle different stocks that looked interesting to him, that moved up a lot on the day or something, and then he would go over to his Wanda machine, which is like Market Surge, and pull up the chart there. That's how he did it. And anyway, so he gives me this ABC printout, and he puts it, lays it out there, and he had a bunch of managers in, the IBD managers, and they were talking about it. And then when they left, he's like, "Oh, hey, Mike, I like your opinion on this, if you don't mind, and on which one do you think?" Because they couldn't decide which version. And so when he left, I grabbed my magnifying glass, that I used to read his, his handwriting on his, in the model books. And I was over there like this, and then he walks in when I'm doing it, and he's like, "What are you doing?" And it's like, "Well, you asked me for your opinion and for my opinion, and I'm just like trying to figure it out." He cracks up, man. He could not believe like how seriously I was taking it. But it's like, if someone asks you for your opinion, like, you really want to put thought into it. And so, then that was kind of the connection we had for projects. And then from there on, we just did project after project after project after project after project after project, man. It was that's what I did with them, on top of trading, on top of for a while I was the director of our research and development at one, and so I had a team of people under me that I was having to manage, as well as manage money, as well as do projects for him, and teach seminars and try to raise my twins. So I didn't sleep much. So anyways, why do I get off on these tangents? Well, it's called Webby Rambles On. So we'll go back to the chart. There was probably a reason, and I'll think about it a little bit later of what it is. But so I'm going to share one more time what how he marked it, just so you have that fresh in your mind. So we're gonna, we're studying it from over here, and this is where we're going to be, and then we're going to go through this whole thing. And so we're going to stop share, and we're going to share the Market Surge, hopefully, and hopefully nothing goes wrong. Okay, so we are going to go down here to February 16th of 90. Is that what it was? Oh, that's 91. Okay, so here you've got this double bottom base in here, and I will say, it's marked as a later stage than it really is. It's saying it's a fifth stage, but really it's a kind of well, let's walk through that because this is a good learning thing. So with pattern rec, how I designed it, that's a story for another one of these, or a few of them that took me a decade to build that, and that was lots of nights and weekends building that. But one of the things on there is what stage base it is, and so let's just walk through this. So over here, this is you can see in here when you hover over it is a 1A1. What does that mean? That means it's a stage one, and it's in parentheses, it's number one in the count of these, meaning this is our original one. Now, why it's a 1A is because from this breakout to this left side high of this next base, it's up less than 20%. So then by definition, it is a base on base. So that's why you see it as a 1B. So it's still a first stage base. So it's our B version of it, but in parentheses, it's a 2. And that's how I decided to just note it. I thought that made sense. And then this one, because there's more than 20% from here to here, it's a stage 2, but it's number 3. And you can see this power from pivot flag on there. That's, you know what? Let me just change the date to over there so you guys can see this a little better. Let's see, 1986. Let's go to 87. Okay, so let's blow this up so you can see this a little better. So 1A, 1, 1B, 2, 2, 3, meaning third base, 1, 2, 3, but it's a stage 2. And this 26%, that means that from here it went up within 3 weeks, that it went up more than 20%. And so it means you're going to hold it for 8 weeks. And so here it shows 26 because that's the max. And I just wanted to have that flag there because that was such an important holding role. So we got week 1, 2, 3, 4, 5, 6, 7, 8. So on that week, then you can decide, and it worked beautifully there, and they don't all work out that well. But now at that point, you can then decide what to do. And that's also why I created these Quicksand Grateful Dead rules, is because there was nothing to do after 8 weeks. Like sometimes you say, okay, well, I'm going to hold it for a year, I'm going to hold it for 6 months or whatever, but nothing really concrete. It was very squishy, and I don't like squishy. So now what happens is, for it to reset and be a stage 1 again, it has to undercut the low of a prior base. And you can see in the thought process there is that if you undercut the low of a prior base, it's cleaned out everyone. Let's go back to like Microsoft again, or no, that's not a good example. Let's go to what else would be around back then. IBM. Okay, so no. Okay, so here on this one, you have this little base here, this 1D base, and then when it undercuts the low of that and forms this other consolidation, now that turns it into a stage 1. And so you have to undercut the lows of a prior base, which it did right there. So let's go back to Amgen. And so over here, even though, the rule was, he would say, sometimes a bear market would reset bases, all bases, but sometimes he'd say it wouldn't. And so that wasn't good enough. Like a sometimes did not work for me. It's like, okay, it's either one way or another. And that's how I like to operate, for better or worse. Sometimes a touch of gray is helpful. Sometimes it's not. And so here, since it never undercut there, and even though it formed this base structure that's not being picked up because it's too deep, because the max depth is 50%, The thought process would be that, you're that far underneath. Look on this week, 912. That the point of a reset isn't that you undercut the low of a prior base. Your point of a reset is you cleaned out everyone who's in there, so then the next time you're buying the stock that it's fresh, fresh merchandise with fresh people in there. And at this point, I mean, it's down 28% in a week, and well underneath its 40 week, its 200 day. That's reset it in my mind, but that's not an official thing yet. So let's just go forward a little bit. Let's go forward to the end of that year, see what happens. So let's go out to the end of the next 2 quarters. So it moves up, and now it's another base up here. So this is your third base, number 4. And but that's a little strange. It's actually not. I got to report that bug, because that should have actually, the fact that it did break out there and undercut that level, that should have reset it, but that base went away. So I'm going to make a note. Well, I'm actively working on improving pattern rec right now. So I will we'll get that fixed. But let's just go. It's really that it only broke out there and didn't even close above it for so what the code was doing is reevaluating that bigger structure as a consolidation. But anyways, don't worry about that. That's for me to worry about. So really, and then again, you're way down here. So even if that wasn't the case, you could say that reset, because your 1987 crash would have wiped out everything. Now let's go forward. Okay, so now at this point, it says it's a number 4, and it says third stage base, but we know that it's not really a third stage base. We're going to call that in our head a first stage base. But anyways, I just want to throw that out there, because it will become important later that we're going to subtract 2 from there, and really 3 from the count, because this is should be a 1A1, which just like over here when we did this very first one, a 1A1, because it's a reset, and then you had a base on base. Hopefully this is making sense, because from here to here is not more than 20%. And I know this isn't really talking about what we were planning on talking about, but this foundation becomes, important, not just for this stock, but for anything. Okay, let's go forward a little bit. Just go out to the end of that August, see what's going on. Okay, it's just base building, forming bases going up, not really doing. Let's go out to the end of 89. Base on base again. End of this. Okay, this is what we're going to focus in on this double bottom in here. Let's look at it on a daily basis. So what he was using for this one is a shakeout +3 to get it. Now, when he was studying it, now he in real time he missed this base, even though this was a monster run for him. He missed this first one, which is a really good learning lesson, is that if you don't get the first base, or even in this case, let's see it on a weekly, our 5th base, but really our 3rd base, that it's, that it's not too late. It's really showing that it's been working. But let's go through this shakeout +3. So this came from Bill's interpretation of Jesse Livermore's comment in How to Trade in Stocks, where if a stock is base building, it's forming a base, and it falls out of that low. So it's forming this base, which is forming right here. Let's go to that day, 1228. So here's the low in the space at this point, we know it's low because it starts rallying up. So the 47.25 level, that becomes that key level that you want it to hold above. Now it comes back down below it. You're not buying it there. It's trying to get support at its 200-day, but you're still not buying it. It's a shakeout plus 3, meaning you shake out below that and go up 3 points from there. So obviously that would be 50.25, adding $3 onto 47.25. Now I converted in the rule was for stocks between $30 to $60 that you would use $3. So that's 5 to 10%. So even though he would adjust the points sometimes just randomly, he would say, oh, it's a $200 stock, so we're going to adjust it by 8 points, or just pull a number really out of thin air. I'm like, that doesn't really make any sense to me. So again, kind of my black and white thing. And I'm like, okay, well, $3 on 30, and $3 on 60, that equates to 5 to 10%. So now we're going to say, let me just break out my calculator here. 47.25 times 1.05, 5%. So that would be 49.61. So that's 5%. 47.25 times 1.1, or I wish it would have been 51.50, but it wasn't. It was 51.98. Okay, so now we know that our buy range, our shakeout, so it shakes out below that 47.25. Now if it goes back up to 49.61, somewhere between 49.61 and 51.98, that we're going to buy it. And so let's see what ends up happening. We'll go out a couple weeks. Okay, so now it really shook out below there. So that's a real shakeout, and it's not quite up to that level yet. Let's blow this up a little bit more. Where are we? 48.75, and we need to get to 49.61. So on this day, it does hit 49.61. It goes all the way up to 51. Remember, the other level was 51.98. So you could say to buy it there, but it's barely going back above the 21 day. And so that is a gray area, and you can split the difference and buy it and add to it. You start at shakeout plus 5% and be adding to it between that shakeout plus up to 10%. So between the 49.61 and the 51.98, or what I like to do is look at logical levels on the chart and just use that 5 to 10% as a general guide of knowing that, okay, it's moved up enough that, where is it logical on the chart? And there's really not one yet. So let's go out another day and see. Okay, so it's come back in, but it's still normal and natural. It's nothing wrong there. Oops, I went 2 days. Okay, so now this is more normal. Like, this is where I'd want to buy it, because now you've cleared back above your 21 day and you cleared above the highs there. But even just coming back over the highs from the prior day after you've pulled back in, that would be a signal to start buying it there. And where is our so it goes up to 51.25. So it's still not to the 51.98, but I would certainly be buying it there. And then let's see if it goes higher, and then adding to it on that day. And then it also went back through your 50 day. So, you could be adding some there just on that. So you shake out plus 3. Now let's go out a week. So now it's going through your double bottom part, which is your 55.50, which is your middle of your double bottom. I know my pattern rec is not picking this up the way I would like to, but it's that's your true pivot there, the 55.50. So then you could be adding to it. So you're using your shakeout plus 3, between the 5 to 10%, to be gradually pyramiding in, and you're not buying more if it goes against you. You're buying more if it's working. So you could even draw like a declining tops line in there, be buying some over there. You could be buying some there because of the upside reversal. So lots of places where you could be adding to it. Let's go out a couple weeks. So it's acting right, and I'm actually starting to fall asleep because this is late for me. So I'm going to, or a long day, I should say, not necessarily late. That I'm going to go a little faster here. So the RS line is acting really well, and if you were using this just to get out of the starting gate, you do have one quick signal there where it goes through there, and then you're right back up. So if you would have gotten shaken out of any of your position there, it's fine. There's nothing wrong with getting shaken out. It means you're flexible, and then just buying it back, as it's going through that area. Let's go out a little ways. Let's go out a month. Okay, so it's dueling around in here. You're up 11% from this. Okay, so it did convert over to double bottom. That's good. Let's go out. So now you're up enough. You're up 26%, 72 weeks. So it's kind of a time element as well. So I would switch over to weeklies. But what you can see is it never triggered your Grateful Dead signal on a daily, meaning it didn't go through that one. But now we're going to switch over and start using the weekly chart. So here was our double bottom. We started buying it in here. We're adding to it through there. And you can see that we've got 4 weeks tight in there. So you could be adding to it right on those 4 weeks. But the point of this was, is it triggering my Grateful Dead sell signal or not? And it's not. You can see that on there. It hasn't triggered anything. So no reason to sell it. Let's go out further. Got another month. Still not sure. Oh, okay. Here on this, on 6/8, it did trigger a grateful, or not a grateful, a quick signal. So on this day, you would sell 5% of that position. So let's say you had sold it down to 15%, and then you would bring that down to a 10% position because of the quick signal. Now, if that goes lower than there, then that's a quicksand and you've got to sell more. Let's see if it does that. Got another week. Okay, it bounces right back, bounces back. So you can be buying those shares back. That big upside reversal after 50 days. So a little bit of a shakeout. That's okay. Be nimble. Buy that back. Let's see what it looks like on a daily. Oh, sure. Yeah, definitely. So buying that back off of there on your daily chart. Okay, let's see. Let's go out a month. Not triggering anything. Let's go out another month. Not triggering anything at all. Look, it's getting choppy in there on a daily. It's getting choppy, but why is it getting choppy? Look what's going on with the market. This is S&P 500 up here. Now the RS line is smoking, but the market is coming into some selling. Let's go to the NASDAQ. Holy cow, look at that. Market is falling apart, kind of feels familiar, but yet this stock is holding up. That is a huge tell. Like, this is reminiscent of this type of move. What was that? Maybe like 15 years ago, like Netflix and there was a handful of stocks that were forming like patterns like this when the market was falling apart and it just didn't want to go down. And then when the market lifted, they just ripped. And it was, shoot, do I have a chart school book? Hold on, let me look and see. So I'm going to, this is, remember my last one that I told you that if we were going to, I'm going to stop sharing, that, I don't know if it was the last one. It must have been the fear episode. In the fear episode that I was talking about when I was going to do, I stopped doing the workshops with Bill around the country because he was just getting up there in age, and traveling was too difficult for him with everything else he had going on with all the companies he was running, and he was very hands on, and it was just too much for him. And he would fly and coach. He would fly and coach with me. In fact, I remember one time we were flying back and we had red eye because he didn't want to have to pay for more hotels for all the staff to spend the night. And wherever we were, I forget where we were, maybe it was Chicago or something, and we were flying back and we were sitting in the aisles, but kitty corner, so not straight across, but across at an angle. And he was still in a working mood, and so he had his newspaper out and he wanted to talk business with me. So I was in front of him, and he was behind me over here, and so I had to turn the whole time, way to not make friends, man. So the lights are out in the plane, and we've got our lights on and our thing, and we're talking shop the whole flight home, which was fine with me. But the people around us, man, and Bill did not get it at all. But anyways, so he stopped doing we taught seminars together, and for the whole story on that Watch the Fear thing, it's really good. It really is. Because I've listened to it a few times, because I'm like, oh, I should have said this, I should have said that, and I forgot all these stories, but then it would have been even longer. But then he stopped doing that, and so Chuck and I were going to do it, and we were charging $3,000 when it was Bill and I for the day, and the firm wanted to keep charging $3,000, even though I wasn't getting paid a dime for those. So the $3,000 was flowing through to Bill. That's fine. It was just a privilege and an honor. And so I said, if we're going to do that and charge the same amount, I want to kill our workbook. So I got this work. Look how thick this is. This is no joke, man. This is Chuck and I. And, they came up with all of these things. And then Justin did all the heavy lifting with the marking up. And then we go back and forth to make sure that we have got everything. They don't sell these anymore. They sell the home study, but not the workbooks, and it kills me. But let me see if what were we looking up? Anyways, someone tell me, was it Amgen? Oh. Dude, Mike, you need to get some rest, man, because you can't even remember why you pulled this out. Page 80. Oh, I know what it was. It was Netflix. It was that time frame. That's what it was. Sorry, man. So I'm recording this on April 3rd. So if you know what happened in the market on April, it was after the tariff thing, and I was fine in the market because I actually came into the day short. I was in cash, and then I shorted right after hours in the Rose Garden speech, and then when it ripped up and then it started rolling, I'm like, okay, I'm gonna put on some SQQ. So it was actually a good day, but it was still a long day because it was stressful. Let's see, 480, but I went home flat because just didn't want any positions. Let's see, 482. Let's see if this is it. Sugar in the morning. That's not the time it was. Okay, if I think of it, of the other one, there was, but it was a really good example because it. I'll just share it on our next episode. I'm sure the moment I stop recording this, I'll remember what the deal was. But anyways, and then here is the home study that with Amgen in it. And I don't think that they sell these printed, but this was the, and I had nothing to do with the actual doing this book. The team put together. Now, I created almost all of the models from 1997 forward. So they were using my stuff, but they did a really good job with this, and it was a home study but that was a home study I wasn't involved with. But I think they did a really good job. It has little clips of Bill walking through the different stocks and how we marked things up and everything. But let's get back into this. Sorry for that tangent, but again, I just want to, you don't know when you're gonna, if you're always gonna have everything upstairs, if you follow what I'm saying. And and I just know, a really close friend of mine, had that happen to him, and that's a terrible thing. And so, you want to document if there's something that and you have, something you want to share, write it down, or while you can, because you never know when you're going to be incapacitated. And so that's another reason why I'm doing these, and I'm letting myself ramble on, even though I know it drives some people crazy, but I just want a record of it while I still have my stuff together, so to speak. So, okay, the point was the stock is holding up while the market is falling like this, and just totally collapsing. Oh, I never finished. So on the plane, so we're talking shop the whole time. Everyone's like looking at me. I'm like, what am I supposed to do? Like, it's my boss, like, and like, it was clear that, like, the relationship. And then as we're getting off the plane and everything, he's, we're still talking shop, and people are like rolling their eyes, and he did not care at all. But, like, that was what was so cool, is that he would fly coach. And I gotta tell this story too. Like, so one time when we were leaving one of the workshops, someone had the idea to hire a limo to pick us all up and take us to the airport. Oh, Bill was pissed. You don't get limos, man. And so we all went in the limo there, and I thought it was a little funny. And I found out afterwards Bill was so pissed. But I guess technically it was cheaper for us to get a limo and get everyone in it than to get like 3 cabs that we were going to need or whatever. But still, he did not like that image. He was so down to earth. And, remember when we shared an office together, just to let you know what a penny pincher he was and how tight he was with money, and very reminiscent of like my mother, who would, growing up, we would always just, when you would have gum, you would have a half stick of gum, like you can't have a whole stick of gum, like that's wasteful, and Bill was in that same, grew up that same way, and the same way I grew up. And he would like turn off the lights when I was still in the office, and I'd be like, Bill, I'm still here. And then after a while I just gave up, and like, because he would just be in the zone of like, turn off the lights to save electricity and keep the electricity bill down again. All the wastefulness I saw around from other people. And he would even like take paper clips, like when he would have to throw papers away when he was done with them, he would take off the paper clips and save them to make sure that they didn't get thrown away. So he would, and so that's a really good, that's who you want to be like. You don't want to be like the wasteful folks. But okay, stop with the tangents, Mike. It's it's a long day. So let's see. Now we've got markets really coming in. Let's go out another week. And you see, it feels like an ascending base. It's not really an ascending base, like 1 pullback, 2 pullbacks, 3 pullbacks without, undercutting. But this does not look classic. But look at how bad that market is, man. That is terrible. 1 wave down, 2 waves down, 3 waves down. That is just horrible, horrible, horrible. Let's go out another month. And it's, okay, I'd mark this. Here's your follow through day on 10/18. So there was our follow through day in the market. And let's see, what is Amgen doing? Okay, so it's bottoming out. And technically you could say, it's certainly in the spirit of ascending base, 3 pullbacks with each pullback holding above the last pullback. But it's really not orthodox. Let's go out further. Okay, so now at this point, so the 18th was this day here. That's when you get the follow through day. So if you knew this one, it's still underneath the 50. If you didn't own it, you would say, okay, you know what? Maybe once it pokes its head above its 50 or over here, that you could buy it. But certainly with this cup without handle on this day, let's see on the 12th. So on that day, the cup without handle breaking out. So if you didn't own it, that's where you could buy it. And this is where Bill was buying it. Because remember, as I said before, he missed this whole move and was buying it out of this base. And notice that during this, that RS line finally triggered. Let's go through this very carefully at 10.5. So it hasn't, let's blow this up a little more. Hasn't hit your RS line moving average yet. Okay, there it goes. Okay, so it crosses through. So that's our first cross. So that's our quick. Let's go out another week, see if it goes lower. Okay, it's just flat. You can see it's flat, so it's not a quicksand yet. If it goes lower, it's a quicksand. Okay, it goes right back up. So you'd sold 5% of it there with your quick. No quicksand was triggered. Let's go out another week. Okay, so you're out of that with just a little bit of movement, just like right here. There was one right here, and then there was one right here. But you buy it, and then you sell it, and then you can buy those shares back as soon as that RS line is back above the moving averages. And of course, in this case, you had the market follow through. Just going back to the market again. So you had your follow through, did come right back down. It's still not over its 21 day, but let's go back to Amgen and walk through this. If I fall asleep on here, it's your guys' fault. No, I love doing this. This is like, it's really like, I look forward to this all week. I'm like, what am I going to talk about? What am I going to talk about? And so much fun. And I really appreciate all the positive feedback. I read all of the comments, and it really means a lot to me. So thank you, every single one of them. And I think I've responded to every single one, and really means a lot. So it's coming out of here. Let's just go out to the end of the year. So let's kind of recap where we're at, just to make sure that we're on board. So Bill didn't buy it down here, but we used the shakeout +3, getting it in there. We've held it this whole way. We just had a little signal here, a little signal here, looks like a little signal here. And it didn't quite come down yet, of just selling a little bit. And so think about that. This entire move from here to here, and 10% of your core position you didn't have to do anything with, and you didn't have to think. So it's not just making you money, it's alleviating pressure. You don't have to think, because you're just using this rule. If you understand the rule and you believe in the rule. Now, if you want to tweak the rule, just study it first and make sure that that it makes sense. So let's go out another month, just ripping up. Let's go out another month, ripping up. It's not testing it at all. Let's go out another month. Okay, this is worth stopping. So, and I will tell some Bill stories about it in a little bit. So here it's been running up, and there's plenty of things on here to add to, but I don't want this to be about the adding and pyramiding into it, because that would be a 5-hour episode. But you should go through this on a daily chart and just go day by day through this and ask yourself, okay, when you're over here, what are you going to be doing? Well, you're going to be freaking adding to that. You're going to be adding to it there. You know, might even add to it there. Certainly add to it there. Certainly add to it there. Add to it there, and add to it there. So you want to know when you look at the chart, you want to be able to know that where you would be adding and where you would be um, reducing it by just looking at the chart. And the only way to do that is to go through them chart after chart after chart. So now you're in this and you've had this huge run. It's up 160% in 20 weeks. And that's just from here. It's up 160%. That's massive. And now it's formed what I would call a high tide flag. So a rapid advance, goes from essentially 60 past 120, so over 100% in a short period of time. And then you're holding in, not giving up much gains. Now we know that this didn't end up working out, but at the time you didn't know that. So I would have been loading up right through there because that's your high tide flag. Now some people could say, oh, that's a little short. That it should be a little bit longer, maybe another week longer. But I mean, it's in the spirit of it. And I guarantee you, if that would have worked from there, Bill would have said that was fine for a high tide flag. So I don't want to hear this. It's not long enough because, well, that's a story for another day. Okay, so let's go out a week and see what happens here. So it's trying to break out of this high tide flag and not acting normal and natural. This is not a normal, natural reaction out of a high tide flag because your flag, your flagpole, and then your flag is there, and then from there it should have been ripping up here. Let's just go out to the end of April, and it really didn't do anything. So let's toggle over to the market and see if it was the market that was dragging it down, and it wasn't. The market was fine, and in fact, here was another follow through day over there, but yeah, so the market was fine. I mean, this was a little problematic, but yeah, that's a little strange. So that's a little bit of like it's bothering me a bit. Let's look and see what the weekly looks like because that's what we're focusing on there. So it's just allowed that 10-week moving average to catch up, but that's weak action following that. It really is. You just have to be intellectually honest. Let's go out a month. Okay. This is where it starts running into trouble and it's forming that base. So at this point, we've had a quick, let's see, 510. No, okay, it's not through there yet. Let's see, 517. Okay, so 517, here's it's a quick at this point. So you're selling 5% of it. Now it kind of sucks because it's upside reversal, but it is what it is. You want to follow your rules. Then it doesn't go lower, so you don't have to sell anymore. Now it goes lower. Okay, so it never went back above that. It just got back to there. So now this becomes a quicksand. So quick, oops. Just go back, make sure we're on this. Okay, so remember your max position during this time frame, 25% max. But when it comes down to these times where you're getting your quick signal or your quicksand signal, that then you're bringing it down to a maximum of 15% before that when it's getting close to it. And then you're selling in chunks of 5, 5, 5, and 5. Quicksand and quick each get 5. So this is your quick. Take no action. Quicksand. So another 5. So now you only have 5% left. But look, it's up 142% from here. This is the lowest size position you've had this entire run. And you haven't had to think. You haven't had to think. That's what I like, because thinking is hard, man. It's hard. And in having rules, if you find a better rule, use it. Share it. So it's just base building. And I'm going to tell you the Bill story in a second about this. Okay. So now we've got 3 weeks tight in here. In 3 weeks tight is something that Bill came up with, where you got 3 weeks that are almost unchanged on a closing basis. Not the interweek can do whatever it needs to do, but and this is why it's shaded in blue, and that's a sign of accumulation. So even though it was underneath your 10-week line, and your RS line is under the short-term moving average, never triggered its Grateful Dead signal, so you still have 5%, but you can't add to it until that RS line goes back through its moving averages, or you get a really clear sell signal or buy signal. So during this time, let me just go out a little further because I don't think it was yet. What's going on with my mouse? Okay, so an upside reversal here, shaking out. Now you've got 4 weeks tight in there. Now that's a signal that in your RS line, you can see it's poking back up. Let's look at it on a daily. So it's starting to firm up, and you're getting ready to buy some of this. And let me just share. Stop sharing for a second. Okay. So this is, I could have told the full Bill story, but some of the stuff is things that I can't tell. But he would tell this story all along about like how he had found this stock on that second base, and it already had a big move, but he had just read a few stories on it, and he wasn't one of those guys who would just do tons of deep research and tons of spreadsheets on things. He would just really kind of understand the concept, kind of more like a Warren Buffett type of approach, but not from like looking at balance sheets and cash flow and stuff, but more the concept of it. And it was like, okay, here from memory, it was like, folks who are going through chemo and they take the Amgen drug and it helps out with their white red blood cell count, and it was in a really material way. And so he's like, this is a game changer, and it was already profitable. It wasn't one of these biotechs without earnings. And then he would project out and say, oh, okay, if they're earning $1 now, I think in 2 years they can earn $2 or $3. And it was like back of the envelope type of stuff that he was doing, but it would give him conviction in it. And so what also would give him conviction is a profit. And so he was pyramiding into this position. He had put everything into this. Now, what makes this trickier is he had started the newspaper back in the 80s, and he had this war chest that he had set aside to start the newspaper with. And I can't really divulge how much it was unless it's been made public in the past. But he always told me, if you are starting something, whatever you think you should start it with 3 times that, because the capital outlays of starting a business or whatever are a lot more than you think. And there's these things that come up out of the blue. And so he would always kind of mentally plan and just allocate this big chunk of money. So he had a big chunk of money to start up a newspaper, very expensive thing, because you get most of your revenue not from selling subscriptions, you get it from ad revenue, but you don't get ad revenue unless you have a lot of subscriptions. So it's like the chicken and the egg type of thing. It's just like someone trying to get a job out of college or whatever. It's like, well, they want experience. Well, how do you get experience if no one will give you a job? It's that same thing. It's like, what advertisers are going to advertise with you when they can advertise with a journal? It has all these subscriptions. So he was burning through a ton of money. And so he had all of his money that was left in Amgen on full fucking margin. Yeah. Let that sink in, right? You've built up. This is my favorite Bill story, because this is what separates Bill from everyone else. He wasn't just doing a crapshoot on something. He had a system. He was building up this position and methodically adding to it. He would pyramid in, and as it was moving up, he would be buying more and more and more and more of it, and to the point where he had 200%. So just think about that, our earlier example, $100,000 account. Well, that means he had $200,000 in there. And then there's a thing with margin that were times where you can actually get more than 200% long. So there would be times where he would, back when I was trading with him, that he would be more than 200% long because he would take some of our buying power. He'd say, okay, you guys can, the team of PMs, like 10 of us, we weren't allowed to go more than 25% on margin because he wanted all the rest of that. Because the way our brokerage would look at it, because I think we were trading through Merrill most of the time, that they would say, okay, your consolidated account, the full account, not that like this is Mike's chunk and Chuck's chunk and the other person and everything, and Bill's chunk. There was just this one big account, and so he would take the margin. So he was like, he would go all in and then some. And so he was 200% long, and the story would go is that he would call up the CFO on a daily basis, say how much money do we have available, find some money for me somewhere. And because he would want to buy more Amgen and buy more Amgen and buy more Amgen. So put yourself in that mindset. You got it all on the line, and you've got this projection that you think that this thing can get out to this certain level. Now, to make it even more pressure, as I've said, like Fidelity was one of our biggest clients, back when I was doing stuff, and Bill was always working with Fidelity, even back in the 60s, like the Jerry Sy, I believe his name was. That's when the whole Sunday night calls came from, when Jerry would have Bill call him, and then years later he would have me call him. So for like 15 years, every Sunday I would call him, and that started off with, that routine that he would have. He would always have, he would be talking to someone on a Sunday night, or in some cases like 2 or 3 p.m.s, towards the bulk of before he retired. For a long time it was just me and him for, I don't know, years and years and years. But maybe it was I don't know. It was a long time. But so Fidelity was, like this key client that he really, really respected. He didn't really respect a lot of people, just calling it the way it is. He really respected Fidelity and Peter Lynch and those folks, and then the Contra Fund and all of that. But so he goes out there to Boston, and he's talking to him about Amgen, and they're telling him, you got to remember. So it's just Bill basically like reading stories and just reading the chart and the tape, and he's up to his eyeballs and beyond in the stock. And they're telling him that the analysts say that there's problems there and that the stock should be sold. And he doesn't. He's like, no, this thing is going higher. So the guts that he had to, to go against like the best analysts in the country, because they really knew what they're doing. And that's Studley, man. Like, if that isn't Studley, I don't know what is, And so he had this big cushion in it. And so let's walk through the rest of that. And it just, he would tell the story in this detail, and just would blow my mind, because I understood what that meant. Like, if this stock didn't work out, like, the firm would have gone away. Like, that's a lot of risk. Okay. So here we are in here, and this is the time where he's in there with Fidelity. He's telling him, you got to sell. And I think he reduces some in there just because it's underneath the 10-week and all. But let's go forward. Nice upside. Okay, so it was right before this. Let's go to the daily. So on here, let's see, on 7-8. So this is another shakeout +3. So let's do the math on this. Take out my calculator. So you're coming down in the base. You hit a low, 113.50. You go below it. Now, when it comes back through, plus 5 to 10%, you're going to add to it. So let's see, 113.5 times 1.05, so 119.17. And then I'm going to do 113.50 times 1.1, 10%, 124.85. Okay. So our 5 to 10% area is 119.17 up to 124.85. So this day, we close at 122.50. So you could have, used that shake up plus three. Really, there's a high there. So let's see, the high there is 118. So no, so yeah, basically right around here or so was your 5%, and that would have made sense because it's actually clearing um, a little prior resistance area and is getting back up to there. So on this day, using the shakeout plus three, you could be adding, or actually, if you had sold your whole position, you could have been out of it. And I remember there was earnings. I don't know if it was that day or whatever, or if it was another week or so. But he was, he was in with that full amount, and he told the story of, he told someone, he's like, well, tomorrow's going to be an interesting one, because of the risks going into that earnings. But he always knew his line in the sand, and he told me, and I forget where it was, that if it got down, and he would, when we went over Pick and Save and Price Company and other ones, he always said, okay, well, his cushion, meaning his cost basis, and where the stock was, he would want to keep that distance far enough that it was. That they couldn't take it all away in one day. Now you got to remember, back in the day, you didn't have the gap downs the way we have these days because the Reg FD wasn't around, and so you get gaps like you see this gap over here on March 6th, but you didn't really have the gap downs on a regular basis like we have now. So you couldn't really use the way he did it. But let's say his cost basis was, let's just say it was around here like 75 or so, that he would be fine with that. And what he would do is, if he had run his cost basis up too high, he would sell his highest cost basis first. So he didn't do LIFO, last in, first out, or FIFO, first in, first out, or average cost. He would do highest cost first. And that's how he would instruct the accounting department. So if he had bought anything, like, let's say he loaded up here, which is what I would have done, now, when it's over here, he would have wanted to sell those shares because he was down a fair amount on those, and he wouldn't want to get into that position, but he would want to hold his lower cost basis stock. So this is where he would have been adding to it. And let's just go out another couple days. So it's just increasing there. See where, as it goes through the standard pivot, how does it look? Okay. So that's a little funny that on the 18th there, it's just a little baby move, which is a little unusual. But still, that was your standard pivot on the 18th. Let's just go there. So that's your breakout right there on the 18th. So if you had missed this whole thing, or you'd blown out your entire position, this is where you could buy it back from a standard position. If you've blown out the rest of your account, anytime in here, that's a lot of stress. I mean, imagine the stress level that Bill must have been feeling, because this is what, 1, 2, 3, 4, 5, 6. Like 18 or 19 weeks long where it's dead money, and he's up to his eyeballs in stock, and Fidelity's telling him to sell. Like, I mean, dude's a freaking stud. Okay, so let's just go forward a little bit. God, I was going to do this in a half an hour. Was I kidding? Told my better half, I'm going to just go record one because can't do it on Saturday. Okay, so it's coming out of here. Let's switch back over to a weekly chart, and let's just go through that quicksand stuff. So we had a quicksand over there, never triggered a Grateful Dead signal, but on here, our RS line was back through our moving averages. So you could have done, following all the rules, you could have bought all of that back and then some, and gone with our 25%, which is 25% is huge. 200% is crazy. So it's still going up. So he was right and Fidelity was wrong. With that, it's moving up. It's not doing anything wrong. That RS line is above there. Let's go up here. So now, and I'm trying to remember. I was searching through, trying to find my notes because I've got like where he actually sold it. And I want to say that he sold it around in here, but the let me stop sharing this, and I'm going to share the let's see, share. Okay, so this is how he said how to sell it. He wasn't saying to sell it in here, but this is where I think from memory he sold it. But he's saying to sell it up here, sell 7 out of 10 days up, gaps up on the daily chart, largest day up, has 390% volume increase. So that's what he wrote there, but I don't think that's really why he was selling it, frankly. Let's see, share. I'm going to go back to, because I'm sure some of those rules triggered along the way where he wasn't selling it. So yeah, that's not how I like to do research. So let's go forward. So now it's going up even higher. I think he sold it in here, but let's just see. On here, you would have had on 11.8. You would have had a quick right there because it's going through there. Quicksand because it's lower. Doesn't get your Grateful Dead because it bounces up. So you are down to 5% of your account using the RS line moving averages. So again, we've capitalized from over here to over here, having a position of at least 5% the whole time, most of the time 15% for wherever it mattered using these rules. But in here, we would have been selling those. And again, I'll have to find those notes of where he actually sold it. But let's go out another month. So then it comes back through it here. So at this point, you could buy it back, but there was no real buy signal. But over here, there was a buy signal as it's going back up. So you could be buying your full position back. Nothing wrong with that. We know it tops out very, very soon. But again, we're putting that out of our mind. Like this just looks like it's back off to the races. Now this is where he was saying that it's 7 out of 8 days in up and your largest point day. But yeah, I'm sure if you go through there are probably 7 out of 8 days in there and probably sometimes in there too. So I don't play that way. But this does look a little funny because this is out of character versus this move versus this move versus this move. It is climax action. I wouldn't call it a climax top at all, but I would say it's climax type action because it's moving at a faster pace than it was before. So that could be a reason to sell offensively some of your shares, but you're still going to hold your core 15%. So now let's go over. Now we've got 3 weeks tight in there again. We got 3 weeks tight there, 3 weeks tight there, 3 or more. About another week. Okay, wait, we got to go back. Okay, so now we get another quick signal. So now we're down to a 10% position. Quicksand because it's gone lower. So and let's just blow this up and make sure you can see that. Let's go back a week. Quicksand, Grateful Dead. So in these 3 weeks, you sold the entire thing. So this is where you sell your entire position and shares that you've held this whole way. So you've bought it, under $10 and you're selling it up 60 without thinking, just using this rule. And I'm not saying this is a foolproof rule. I'm saying this is a rule I developed for myself, not using this as a sample in there when I was creating. And it is always wonderful to go back to these old ones and see how it would have played out. So let's just go out to the end of this month, see what happens. So it's just going lower, living underneath there. see how it's got another month, it's just not the same stock anymore. And this RS line is now living underneath there. So let's look at it on a monthly chart, like that massive move that you were able to capture um, using using these rules that are very objective and they're black and white that you can put into a program. So I would highly suggest that you uh, that you end up going through and doing this on a daily basis, or at least do it first week by week and go through and ask yourself every week, okay, well, I know what I'm going to do with my core if I'm following the Quicksand Grateful Dead, the 15%. Well, what about this 15 to 25%? What am I going to do there? And ask yourself, what rules could you use, selling into strength as things are getting, stretched above moving averages or whatever. Just ask yourself, you know, um, different questions. But as I think of other things that he told me with that story of the Vatican, I will certainly share these on future podcasts and episodes. But I remember, I would always hear the same stories over and over again, and he would ask me like, "No, Mike, I've told you this story before." I go, "No, I'm not sure. Why don't you tell me?" And my favorite one was the Vatican story. I don't know if I've told this on here before, but so when he was running money early on, because he ran outside money early on in his career, but later on he didn't want to run outside money, and that's a big topic. But he was running money for the Vatican, and he was a religious guy, but he was running money for them, and it was a big chunk of what he was running. This was in I think the late '60s, and it was 20 or 25 million when it was his biggest account. And I know that 20 or 25 million doesn't sound like a lot now, but back in the day, it was. Now, people are in hundreds of billions of dollars and stuff, and so it's just a whole different structure. But back then, so he's running money for him, and Bill was very clean with stuff, and the compliance rules were very, very strict, and that's why I follow very strict compliance guidelines. Even more so than whatever our rules are. I always keep it very clean, and that's my comfort zone, and that's how he was as well. And so he had these stories about the Vatican, and he would tell me about how he would, when he would go over there, when they would want him to check on things that or just give him an update, he'd fly over there and he would go down in the catacombs in the Vatican. I just thought that was fascinating, especially if you've seen like read the Dan Brown books, or any of those movies like with Tom Hanks. I can remember Dan Brown, and I can remember Da Vinci Code, and like The Last Symbol and things like that. Really good stuff, good books. And but he would go down. He would say it was this windy staircase, and it was like really dark, and it was just like this cave type thing. And there they had put, to reconcile all the trades, they put one of the firm's big computers. You got to remember, back in the day, these computers were huge, like mainframes and stuff. But this big IBM, I think it was an IBM computer that they had down there, that was the firm's. And he just always thought it was really cool. He didn't use cool, but he said, I forget what word he used, but he didn't use words like cool. But anyways, I just love that. It was just fascinating. One of these days I need to go to Italy and check out the Vatican. I would love to do that. I just haven't had the time. Gotta make the time, man. The point was, then they started asking funny things, and it really bothered him. And in Dave Hatman, if you watch IBD Live, he wrote an IBD book, and he has some of it in there, and and goes over some of the details. So if you have a copy, you can get access to it. But essentially, it was, he started thinking that they were doing something shady. This is the Vatican. He thought they were doing something shady, so he sent them back their money. Imagine thinking that your client is shady, and you sent back your money to your biggest client. and their biggest client is the Vatican. And it turns out they were doing shady stuff, and so you can do some research on it. And I think one person ended up killing themselves or was killed during that whole incident. So there was some shady stuff. So nothing against the church at all, but the church is just filled with people, and sometimes they're good, sometimes they're bad, and you get bad apples in any walk of life. And so, yeah, I always thought that was fascinating. And so my two favorite stories were the Amgen story, because he had it all out there on the line, and he's going against what everyone thinks. And that's how I just do things too. It's like, I don't care what anyone thinks. I'm gonna come to my own conclusion. I'm not gonna go against the grain just to go against the grain. But if I think it's A and everyone else thinks it's B, I'm fine with that. And so is he. So that was the Amgen one. And I'm sure there were other things, but it's really late for me, late day, and I shouldn't do this late in the day, because we'll move on. So we're done with stocks. I'm just going to do my music thing now. So if you're not into the music thing, thanks for watching. I really appreciate it, and I hope you get a lot out of these. And again, go back and rewatch these things. Take notes, and don't do it exactly the way I do it. Like, feel free, change it up. Like, if you're like, oh, well, Mike missed this and he should have done this here, dude, more power to you, man. That's what I want to see. So anyways, switching gears, we're going to switch to stocks, and then we're going to wrap it up. So who do I've got on here today? One of my all-time faves, Stevie Ray Vaughan. And when I ended up in Austin out here, that was just like, it was some weird like karma thing, man, because just being close to where he was, huge fan of his. Now, if you don't know who he is, let me just share some let's see. Okay, here's Stevie Ray. You should this is what I was gonna, one of the reasons why I was wearing the Stevie Ray is he passed on August 27th of 1990, which was part of the terrible helicopter crash. And it was I just stopped sharing. So it was after this concert in Alpine Valley, and he was there. Who was there? So Jimmy Vaughn, his brother, who I've seen live a few times, just really good, really good, and totally different than his brother. And you had Buddy Guy, we've talked about him, and Eric Clapton. We talked about him, I think, last time. And there was Eric. EC was here up there, a great album. Who else was there? Probably someone else. And Clapton said, like, Stevie was the man, like that was like at the end when they did, was it Sweet Home Chicago that they did? I'm not sure if that was the finale. Can't believe it. I don't remember off the top of my head, but when they did it, he just said that it was just unbelievable. And then when they were all going back to the city, there was a helicopter, and Stevie got on it, and there was an empty helicopter seat, and he got on it, and they ran into the side of the mountain there, and they all perished. And it was just beyond sad day for music, because here was Stevie, and Stevie was like so good, and he was really like Jimi Hendrix, like reincarnated. If you really look at Jimmy and what he was doing, and it wasn't just because Stevie played some of Jimmy's songs, like everyone thinks of Voodoo Chop, Slight Return. If you ever wanted to know where that Slight Return came from, it was a play on words of the song that obviously Jimmy wrote and put on all on Electric Ladyland, where All Along the Watchtower is and everything, and that double album, which is so good. And anyways, but he was really like him, like reincarnated, but just taken in a different path. and he really fell down into the drinking and drugs in a really bad way. But then he got himself sober. Like I've got myself sober, and I was never a druggie, but I drank a lot, and got himself sober, and then dies in this helicopter. It's such a tragic thing. It's just a reminder of how short life is. And so if there's any artist or anything that you want to see, like, go out and see them. That's why I try to go to as many concerts. And every time I think of, like, I never got to see Stevie, and I never saw Prince, and like certain people I never saw. It's like really, really regret it. But let me share what I think you guys should listen to. Let me see. That's not popping up. Let me open up my Spotify. Close a couple things down. Might make it easier for me. Okay. So here's our Spotify of Stevie. Let me just move this over so I can see a little better. And where I think you should go if you've never listened to him before. If you've never listened to him before, I would go with The Sky is Crying. This isn't any of his popular ones, but this is one that was put out right after he passed away, and it was kind of a best of things that were unreleased. And I would go straight to Little Wing, which is one of Jimmy's tunes. But I've got to say, Stevie did it better. And it's hard to say because it's kind of sacrilegious to say. And then Life by a Drop. Anybody who's had any like drinking issues or anything in their life, like it'll hit home, or anything in life, like life is precious. So that's a really good album. And of course, Texas Flood is kind of the go-to one for most people, because Texas Flood, the song itself, is just freaking perfect. Pride and Joy is his most popular. I wouldn't say it's his best, it's just his most popular one. He did Mary Had a Little Lamb, and that was kind of a play off of Buddy Guy, because Buddy Guy did that one too. And then Lenny, which was his wife, or then they got divorced, but it was a really mellow instrumental, and really, really touching, as much as an instrumental can be. So that's a good one to go watch or listen to. This is beyond great. It's in with Albert King in the studio, and I would watch this on YouTube and watch the videos of it, and especially the pep talk. If you don't listen to anything else, it's only 58 seconds, and it's Albert talking to, and so Albert was like up here to Stevie, but Stevie was more popular, but he really looked up to Albert, and it's just some really, really just good things in between of like, who is Stevie, and the little talking in between, like the old times and stuff. And it's just great. And of course, you got Stormy Monday and stuff. And the playing on there is really loose, because you could tell like Albert didn't really seem to know his stuff. And it was just really like, it was great. And I love Albert. He's so unique. And then what's another really good one that I wanted to share with you? Let me share all of these. So the Mantras, or Live at Montreux, 82 and 85. Now, what's fascinating about, I'll circle back to that. But what you should do is listen to, which one is the best take of it? Probably Live at Carnegie Hall. Whenever he would do, no, it wasn't live at, he didn't do it there. That was a big deal when he went to Carnegie Hall. Which live one was it on? No, it wasn't there. Let's see, it was Life Without You. Oh, so it was on a few of these different ones. Oh yeah, it is on the Live at Montreux. I forgot that. So let's go there to this album here. So 1982, and 1985. And I find 1982 funny because that was the beginning of the bull market from 82 to 2000. But Life Without You on here, listen to that in any of the live recordings because midway through, and it's so touching. And shoot, it's saying, it's giving me some, stop sharing. Hopefully that was sharing. It's my program is giving me some issues. So I'm going to stop sharing there for a second. But so the Life Without You, during the middle of it, he would just stop and talk, and it was very motivational, and it was really everything I'm about. You can hear in the words that he says through that, and like helping a brother out and things. And please listen to that, and I think you'll dig it. And then one of the things I do out here, the first time I had any break when I moved out to Austin. So I started became the head PM at a family office out here. So a family office is like a hedge fund that doesn't run outside money. It's just the money of typically just a small group of people or a couple individuals. Um, and so with that, like I was working up until Friday, did my SMT video with Ali. I was on a flight out here Saturday morning. So, didn't finish that until after the market closed there, packed up my stuff and flew out here. And then I would fly back and forth to California about every other weekend until we moved out here, until I got the family out here. My daughter came out. My son was staying in school in San Diego because he was just starting college, and then my daughter was able to do the first year because it was a COVID thing from here. So that was wonderful getting to have her. I wish he would have been able to come out here too. It was really hard being an empty nester. But the first weekend that I had any free time after like just working like 24/7 starting up this new gig. First time I had any downtime, the only place I wanted to go was to see Stevie Ray Vaughan's statue as a holy place for me, and it's a very special place. And whenever I have any troubles in life or anything that I really have to think about, I'll go down there. You'll find me there lots of weekends. Some people go to church. I go there, and I was an altar boy growing up, so I spent my fair share time in church and Catholic boys school and all that stuff. So I've done my fair share, but that's my place. And what I do is every once in a while, and I haven't done one in a few months, is I do. Where did it go? Oh, I had it up. There it is. I do these Webby walks where I just invite anyone who wants to come, who happens to be in town. Let me share a screen. And this is from our first Webby walk, and here's the statue, and that's where I like to hang. And then, the next time I do one, if you've got a dog that can handle the walk, this one, I think it just had surgery and can only walk a little bit of it, but and we walk for about an hour, and then just chit chat and everything, and we've done several of these, and it's just like probably my favorite thing to do, frankly, because just wonderful people. Every single one of them has been fun. So I'll announce the next time I'm doing one, and we just walk along the river here, and I always stop there at the at the statue, and that was really the only outing when we got the dogs out here, the girls as we call them, Georgia and Violet. In Georgia passed it on January 20th of 23 at 10:17 in the morning, and still not even remotely over that. This is her little Eddie Van Halen rug there. That was her rug that I used to keep underneath the desk because she would always be with me. She would want me to be working, and so she would kind of drag me. She would follow me all over she was a Saint Bernard, and she would follow me all over the the house, and she would want to try to get me in here because she just loved being in here with me, and she would lay on that underneath. And so that's why this is my most precious thing that I own. So, anyways, the first place and only place that we got to take them was down there. And so they got to, and I've got some pictures that I'll probably share online of Georgia and Violet. Violet was a sweetheart and a golden retriever, and she passed on the same day that Bill passed, 5/28/23. That day fucking sucks. But I got to get through some of these without some emotion. But anyways, the point was it's just a very special place. And after that outing, they both became completely housebound, and it was a hospice here for over 2 years of just 24/7 care until they passed. And so it was a very special. That place makes it even more special because it's the only place that they got to see out here was that, and I'm glad that they got to experience that with me. So if you're ever out here, whether I'm doing a Webby walk or not, go down there. You might find me there. And with that, just do the message of Stevie, which was really be kind and help a brother or sister out when in need. And until next time, I hope you got something from this. I hope the rambling wasn't too much. And be safe out there. Peace.